Hello everyone, Jesse Webb, TradersPro. Let's take a look at current market conditions as they closed out yesterday. We still got our long-term bear market. You can kind of see it rounding off just a little bit here. Part of that is the last couple weeks, last couple months really, and we'll take a look at that. We did shift back over to bearish and a bear market, which we've been flirting with that back and forth with this bearish and mildly bearish state. Essentially what that means is just extreme caution now at this point, because when we have these two things together, we know that we're in a bear market. We're in this downtrend. Yes, we're moving higher, but the risk at this point is that this move back up again is just a counter trend move. We hit some resistance and we continue this overall slide. So these are the locations that this starts to feel like where they're going to find some support, we're going to bounce back higher, or we're going to accelerate to the downside. And the more acceleration to the downside we see, the more we will probably get. So you just get that continuation of price movement in one direction or the other. But we're also, again, we're at a location where we could bounce, find some support, move higher, sitting right at this support line, right at this trend line. We'll pull in that other S&P chart here in just a minute. We do have momentum, which is kicked back into this bearish trend again. We'll see what today brings, if we get any stability and support to the upside. But we're seeing continued acceleration, or some indecision with a slight bias to the downside is what we're seeing right here. Just not a lot of clarity. The overall breadth indicator still right in the middle, and the chart on that looks like this right here. So you can see we're getting, we're just kind of stuck right in the middle now. You can see where the extremes are. Extremes are there and there, and so we're just, we may get a support. This indicator also can work, similar to a chart or similar to a price pattern, a stock chart where you're getting support and resistance. And so a lot of times you will see if we're on the under side of this trend, that it bounces back up, runs into resistance. It can work the same here where we actually are finding some support. So we could find some support and ultimately move back up that direction. So we'll watch that in the next couple of days. Sentiment is still really high, and that could turn out to be a good thing. The contrarian perspective is that if everyone is bullish, then there's no bears, right? At least not yet. So once everybody starts running for the door, then that accelerates, because everybody's on this side of the trend right now versus anybody being on that other side of that overall perspective. So that can be a contrarian type indicator, but price action is our overall ruling all, essentially. In this buy sell ratio, we've got some upper range now. We're reaching that, starting to pause back a little bit. And as I mentioned yesterday, typically this doesn't just do a V reverse. Typically takes a little bit of time on that side of the trend, whichever side it is. Whether it's down here, you may get a couple of weeks of that. So I wouldn't anticipate a lot of activity outside of this current trend range that we're in. And let's take a look at that on S&P 500. So if we've got SPY, you can see that we've just ticked down now to a sell, which is essentially just now we've just notched that trend over into more of a downtrend, okay, or at least the risk or the beginning of a potential downtrend. Down here, we didn't get any continuation or acceleration. We started to move back up. The yellow is that watch caution location. Green turns back into a buy signal. We knew that we were in a buy signal, but we also knew that we're in a long-term downtrend. So we have those two perspectives to be aware of. Our long-term downtrend, yes, we're moving higher. This is now the risk that we move back into that overall downtrend. And we're seeing that now on S&P 500, so it could be relatively early in this trend, but you can also see I'm not drawing that perfectly, but essentially this trend line really close. We would have some support right here. So if we start to slide down and start to break through some of these levels, then markets are going to be at risk of retesting these lows, and that certainly could be the case. But this is what day 1 or day 2 or day 3 of a new downtrend looks like. So you've got to decide right here: are we going to position ourselves for more bearishness, or are we just simply going to position ourselves in cash so that we're out of the potential risk of more downside, or are we going to look to profit the other direction? And the way that you would do that is, if you go back to the direction alerts, it's telling us that we want to traders and investors should consider trading with a bearish bias by shorting stocks, buying inverse ETFs, or buying put options. Those are obviously the more aggressive strategies. The more conservative strategies are move to cash, tighten up your stops on winners, sell any losers, and then from there, as far as actively making new positions, you could go into some of these other ideas as well. Again, remember that the muscle ETFs is a great way to look for bearish trend ideas, because you get inverse ETFs here as well. Let's see if there's any new in this buy trend. So SDS, which is an ultra short. So if the S&P 500 is showing a new downtrend, then the inverse of that, which is the SDS, is going to start to show an uptrend. So these inverse and leveraged ETFs, which this is a 2x, which means it's going to go up 2% for every 1% that the S&P 500 goes down. Okay, that's an inverse, and it's an ultra inverse because it's multiplied. So it's a double leveraged to the downside ETF, and it's a way to be able to hedge a portfolio, or to be able to just profit from a downturn without going short or without buying put options. You can just simply be long a directional ETF, and in this case, an inverse leveraged ETF, and you can find some of those by looking at the muscle stocks list, and this will pull up both long and short. So you're getting SPX, which is the triple, and that's going to show you the same thing. So in this case, SPXS is leveraged by 3 times. So if the S&P 500 goes down by 1%, then this is going to go up by 3%. So again, a way to be able to leverage, hedge a portfolio, profit from a downturn. This is one of the ways to do it. In fact, this is probably the simplest way to do it, in my opinion, is to be able to look for an inverse ETF. They're designed for this. They're designed for these shorter term trades, for hedging, for a little bit of speculation, and versus anything long term. So they really are a trading instrument. If we take a look at the current sectors, we are still seeing oil construction is bumped up there, which is really an interesting phenomenon as well, kind of leading into potential recession, or maybe there won't be. That's an interesting sector to be sitting at this location. Oil and energy popped hard yesterday. Aerospace, transportation, those are also rounding out that group. So remember, you're just clicking on this number right here, this 34. That's going to give you the 34 leading stocks in that sector. From there, you can go in and take a look. Here's one, CHCI, that's really been having a nice move. Obviously, it's a little extreme by this point, but some names for you to look through and go through that list. If you don't have full access to the site, you can sign up with the link below. We look forward to having you. Have a great day today. Bye now.